Hello and welcome. Today we have two consultants from the Netherlands, Bas Rebel, Independent Treasury Consultant at BRFC. Welcome.
Hi, thank you for inviting me over, Jack.
And Gerben Weistra, Partner Transfer Pricing at Ectacon. Also welcome.
Thank you. Good morning.
The Corporate Mike Foye, Director, Global Treasury Operations at Mondelez International.
Yeah, hi Jack. Nice to see you again.
Who are going to be discussing tax and treasury with particular focus on why corporate treasury can no longer tiptoe around tax due to the new OECD regulations published in 2020 and the implications for corporate treasury operations. First, we're going to be looking at the new regs. Gerben, can you talk us through this as to what's happening here?
Yeah, to provide a brief introduction. So I think what we've all seen around the world is tax authorities being far more interested in international tax. And there's been a lot of focus, the base erosion and profit shifting project. A lot of countries coordinate these efforts through the OECD, and they've published quite some reports that affect transfer pricing in recent years. And as part of that project, in February 2020, transfer pricing report on financial transactions was prepared. That affects us in a way that it's not all new in the report, but it's the first time there is actually a report on financial transactions transfer pricing. And so we see that in practice now. And this OECD guidance, together with recent jurisprudence, actually has an impact on what we have to do day to day. And what it mostly comes down to is that where in the far past we were just pricing the loan correctly. So we had a loan on paper and that's the one we were pricing. You see that over the years, more and more the focus has moved to the substance and business rationale. So to understand what is happening and why do you have the instrument you have. So the purpose is not just pricing the loan as agreed at arm's length, but you also have to look at, well, is it actually an arm's length loan? Then in addition to that, more and more countries have transfer pricing documentation obligations. And that of course creates more transparency because every year you're preparing those documents that explain what you've done. And most countries, you only provide those when the tax authorities ask for it. But more and more you have to provide it proactively. And all these requests for information, of course, also impact the day-to-day treasury operations, because that's where we tax or transfer pricing people go for all this information.
Mike, how is your company, Mondelez, reacting to this? Have you done anything new because of this?
I think what we've done is to embellish what we've been doing before and more formalizing things, but we also, to that extent, are doing a lot more research and background, as Gerben points to there, substance and business rationale in terms of how we're evaluating all these intercompany transactions. So there's a lot more detail in what we're preparing when we go into looking at a loan and what its purpose is for and what it's going to be priced at. There's a lot of ongoing documentation and substantiation of, why we've got those loan relationships in place too. So we have got quite a lot of safeguard and information available for our tax colleagues for all the intercompany loans we do now.
There is a famous case, maybe infamous case in Australia that showed what's going on. Again, Gerben, can you talk us through this and set the background for this? Because this has implications for everyone.
Yeah, it's indeed one of the famous cases, I think, in our area. So the Chevron case dealt with, the main question was, well, are the terms of the intercompany loan at issue arm's length? And to immediately jump to the conclusion, what the judge found in that case is that if the loan had been agreed between independent parties dealing at arm's length, that the borrower would have provided securities in that case and agreed covenants. And as a result of that, the interest rate would have been lower. So this is a clear example where a lot of the discussion in the court and a lot of the evidence presented was about the actual terms and conditions of the agreement and how third parties would price that. And the judge in the end went back to essentially the basic question, well, would a third party have done this? And a lot of the discussion in the court was about, could a third party have done this? But a judge basically said, well, you wouldn't have done it. It's not in your benefit. So I'm adjusting certain parts. And that resulted in a lower interest rate.
Mike, this really does have implications. As a result of this, have you done anything new, or are you changing your systems?
Haven't per se gone through any systems changes as yet. I think, we would like to see a system that could give us, all the magic detail before and after the loan, other than just the basic recording of it. But in terms of, how we go about the loan appraisal, how we set out things, we've had to develop a framework that takes into consideration some of these things. One of the key areas here is that, speaking maybe generically for most treasuries, we've all got intercompany loan agreements that we probably have all had as a kind of harmonized standard from a very beginning, something that, suits the company profile, suits most markets. But what we're looking to do is each time we come across these things is check upon the ongoing relevance of that intercompany loan agreement, partly in what's being pointed out in this case here, because you need to look down and a bit further into those global agreements to ensure that they cover for local legislative differences that there may well be. Things such as solvency laws in different markets may mean recoverability is different, more difficult for a lender, and in which case you should have some kind of a risk pricing onto your loan, which maybe you wouldn't have considered before. So it's not one thing, but it's a number of different things about all the facets of the things that come together for intercompany financing that you have to really unpick and look again and make sure that you're being very tight with everything you do, including the substantial aspects of why you're doing it in the first place.
Bas, this is just huge. Where are you coming from on this?
Well, I think if the real question is, would you do such a loan instead of could you do such a loan, we cannot rely anymore on simple bullet loans that cover everything. So that implies that, well, just what Mike said, first of all, you have to assess upfront whether or not you are, what the rationale of the loan is, and that you have documented the risk decision. But secondly, the whole balance sheet of all the affiliates becomes more volatile, and that may have implications for the implied risk ratings going forward and subsequent loans that will be issued. Because the balance sheet is a little bit more volatile, you have to revisit the loans and maybe issue new loans if there is new activities that need to be funded. And the second loan then probably cannot be priced at the same risk level as the previous loan. So everything becomes way more dynamic than ever before. And that implies that Treasury and risk has to really work together on a regular basis to review the intercompany loan structures and the capitalization of the different affiliates. And that has implications for your dividend upstreaming, because maybe you have to look at what are you doing with surplus cash. Are you going to repay, or are you going to dividend upstream dividends? So that becomes way more dynamic discussions.
The other problem, Mike, is that the audit authorities don't come at you immediately. So you have to have documented all this now to answer questions in 5 years' time. How is that happening in your organization?
Well, what it is here is, maybe it's twofold actually, in terms of, who wants to be able to understand what it is that you went through and evaluated at the time the loan went in place and how it's reevaluated. It's also transfer pricing guys who basically are going to be the interface between you and the tax authorities generally, depending upon where you stand. So what you need to develop, or is to be developed, is a framework that allows you to bring over those treasury risk metrics that we've all just discussed here, actually, and about the substantial terms of the loan, the rationale why, the purpose of it from a lender and a borrower's point of view, all those perspectives and the backing cash flows information, they've got to be kind of ordered in a way in which it's transferable between you as a treasury function, understand all the technicalities, and to the tax teams within your organization, who've then got to relay that, describe that, put in those terms to the tax authorities. And that's all great while you're all doing this at the very start, like you mentioned, but this has got to stand the test of time and be reevaluated. So we need to create, and we are creating, a framework of almost ticky boxes, try to standardize as much as possible into the evaluation process, then try to describe what we've gone through as a checklist in terms of making sure that we're adhering to all the standards that are in place, and reevaluate that, keep all the history of it, and make that available for our transfer pricing teams. But inevitably, it's not just going to explain itself in just paperwork. Again, there's got to be fluid discussions about, what really is meant by all of this. What's the substance again? Some of the qualitative aspects of some of those loans, as well as the quantitative, would need to be explained too. So you've got it there predominantly to be reinvented, appraised, shared, but you've still got the fallback, the reviews, all those other processes still need to go on inevitably over the course going forward.
Which is a huge documentation problem. And this also applies to cash pooling, which is also impacted. Gerben, can you explain this? Because this is getting worse, isn't it?
Yeah, I think what you see here again, all the matters addressed by the OECD are not entirely new per se, but for many tax authorities, it will be the starting point in a transfer pricing analysis, because a tax inspector can now start with your transfer pricing documentation and basically has a report that spells out the questions they can ask. And I think when we think about those questions in setting up or analyzing a cash pool, the problem is now that you may have to answer them in every single country. And often, of course, we look at a cash pool from a holistic group perspective. But in the documentation, you now have to support that it's actually beneficial for that particular entity in that year. And sometimes, well, for example, if there's seasonality, so you need a lot of cash in the second quarter and end of the third quarter, your balance may be positive at each balance sheet date, and nevertheless you have cash pool expenses, the interest expenses in your P&L. That's the sort of things we probably have to better be able to explain. And it's not something we don't know or don't understand. It's just that we don't necessarily have the level of detail available for each and every country for each and every year. So it's always a lot of work to get this level of detail from the systems after the fact. And then there's other questions like, well, how do you actually split the profit you realize from a cash pool? Should it benefit all the members or the cash pool leader? And last but not least, if you have a long-term negative balance in the cash pool, should that be converted to a loan, or should you just convert the interest rate charged? Just to name a few of the topics we're running into.
Mike, this is another nightmare, is it not?
Yeah, I mean, I think, when you look at this, a lot of these questions are the ones that treasurers have been asked and continue to sort of have to try and, prove really, I guess, through evaluations of pooling mechanisms for the years. You address the first one, why the pool participants, why are they better off? If you devolved or delegated cash management to each and every entity, it's got to put its own controls in place, it's got to make its own interest rate decisions, it's got to do its confirmations, its bank transfers, it's got to record the deals, it's got to go through swaps, there's a lot of benefit in the entities not having to overmanage that and to do it centrally. So I think we know that pragmatically that seems to work. But then that starts your problems, because now you started to pool everybody. In terms of a responsible header, you would take some form of evaluation to ensure that you've got safeguards against people who are not just drawing the pool into tomorrow. That there are limits, because the pool itself has to fund from somewhere. So the degree and modicum of control and monitoring of performance is within your own policy of how people can interact with that pool, your own ground rules. I think that can possibly hedge some of your risk here, if you like, within that documentation. However, you still need to do more scrutiny. I mean, pools are pools are pools. Once you put them in place, they function well. To be honest, I think from a general treasury level, people will just let it carry on. But what you may have permeating in there are dormant balances, things where a debt structure has been inadvertently put in place, it hasn't been addressed perhaps. That becomes some kind of long-term non-moving thing. And you really need to use your treasury management system and other reporting tools to get those out, look at them. Whatever element of any pooling balance seems to be a balance of either deficit or surplus, maybe for a year or two, over and above any other peaks or troughs that happen, that probably needs to be taken out and in itself then put in as a different loan footing and priced differently.
Bas, this adds another layer of complexity. Is it going to fundamentally change cash pooling?
No, I don't think it will change cash pooling as such, but I think one need to realize that intercompany cash in the cash pool, cash on a standalone bank account of a subsidiary is fundamentally something different. Nobody will ask any questions about the liquidity that you have put on an external bank account. But when you transfer it into the in-house bank, all of a sudden it becomes a structural balance that is taxed quite differently. That is one thing that you need to realize. What I think becomes more important is that you have your systems up and running, that you have the data to not only to monitor the balances by affiliate, but also to document all the questions or the responses to the questions that the income revenue can come up with. So you need to monitor on a regular basis your intercompany current accounts. And if you don't have a system that is recording the intercompany current account on a daily basis in an easy way, the documentation and the monitoring becomes more difficult. So this is more an issue of technology behind the zero balancing than anything else, in my opinion.
But it is fundamentally going to change the level of involvement in describing what you've done today for the authorities in a few years' time. Gerben, is this going to make that much difference?
Yeah, I think to some extent it is, because I think what you're talking about is basically that what we always did and what the Treasury people knew they were doing, we now have to explain it to the tax authorities. And the fact that those are not people that deal with Treasury every day is increasing the level of documentation a lot. So it's mostly that there's additional stakeholders for the Treasury department, which implies an ongoing increase in documentation. And I think that's where tax and Treasury have to talk and work together to see what is it we want to gather over time and how do we store it so we can find it back in a few years' time.
That's a good way to summarize where we are. If we bring all this together, Gerben, what would be your key takeaway? We've listed a few here, but what would be your particular ones that you'd be stressing to your clients?
Yeah, maybe to mention the first bullet briefly as well. A lot of the new guidance is interpreted by tax authorities of a clarification, what was always the case already. So they do apply it in the current tax audits already. So the first message there is be prepared and start gather and keep the documentation you have. The other message, I think, is that you have to think a little bit more about the process applied, that you do it consistently, and that you document the steps taken in that. And I think that's always difficult if you have to do that about your own job, because the Treasury people will consider certain decisions, what instrument to use, as a known answer. Everyone understands we give a loan in this case. But now you have to explain more about it. And that's, I think, the big change, that we have to explain more about the day-to-day decisions made within the Treasury Department on the instruments issued and the terms and conditions.
Mike, as a corporate rather than an advisor, what would you advise your corporate colleagues is the key takeaway here?
Well, I think it really is, and maybe we're touching the themes all over, and maybe it's a little bit repetitive for people, but it really is, that background documentation about how you evaluated and started that loan, and keeping all of those considerations in place, ensuring that you've got the trail that says that this substantiates exactly why we needed to do something, and having that to hand, ensuring that that's understood and it's shareable with your tax colleagues within the organization, and therefore explainable by them to others. There's no corner cutting here, and I think, it'd be fair to say, I think from a Treasury level, that a lot of what we're seeing here that needs to be done has already been done. We've already been doing it in different pockets and different ways across the ways in which we've been working over a number of years. But now it needs to be absolutely more formalized. It now needs to be applicable to every territory. That means to say there has to be a standardization at the front. And really, it's getting yourself in order to ensure that you can fulfill that framework from now, or if not even before, to ensure that you're not exposing yourself to risks going out into the future.
And Bas, your key takeaway from this?
Well, I think this is just underlying the fact that the Treasury will have to step up as being the in-house bank, not just for cash pooling and for payments, but now also very much so for issuing credit intercompany-wise. And that implies that you have to emulate a couple of processes that external banks are doing and that are not necessarily emulated yet by Treasury. And that's mainly around the credit acceptance and the credit monitoring. And that's from a documentation perspective, I guess it's all, we were talking about collateral and other conditions, terms and conditions on lending. Well, if you establish collateral, that also implies that you have a new process over there. And that's what treasurers typically wanted to avoid just for the sake of convenience. So yes, I guess it's about Treasury stepping up as being the in-house bank.
Very interesting. I've got lots of takeaways, but the one thing that I really feel is that you can't cut corners anymore. You need full documentation. Mike, what would be your takeaway, just single takeaway from this?
Get pally with your transfer pricing teams internally, and you two have got quite a future together, and let's make friends now.
Gerben?
Yeah, agree with the make friends and get gather and keep the documentation you have of the decisions you're making.
And Bas?
Get your house in order, act like a bank,